Warren Buffett spent 50 years swearing he would never touch complex tech. But the SEC just confirmed a $37.8 billion shockwave. Berkshire quietly surged one tech giant by 658%, officially blowing past his iconic $32.5 billion Coca-Cola position. But while retail chases the rally, they just dumped 58% of a major credit titan. Let's look at the numbers, because this is a textbook masterclass in modern value investing. Berkshire expanded its voting Class A shares by 45%, while boosting its Class C non-voting shares by a staggering 658%. Why load up on the tech giant now? Remember how Charlie Munger and Warren Buffett famously kicked themselves for missing Google years ago.
Myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it.
Under operational CEO Greg Abel, that mistake is finally ancient history. To Berkshire, Google is no longer a speculative tech play. It's a digital monopoly, a cash-printing infrastructure asset with revenue streams far more reliable than most legacy industrial giants. Another major move: Delta Airlines. Berkshire doubled down on this position to over $5.3 billion. Why buy an airline during uncertain macro conditions? Delta's CEO spelled out the core business driver.
For the next 5 years, it's about as long as a crystal ball as I can give you, we're going to see that continued build in premium. It's what's driving this industry forward. It's what's separating, I think, the majors from some of the discount carriers.
Alongside premium travel, they are targeting structural supply shortages. Home builders Lennar and Horton are dominating the market because the locked-up existing home market is pushing buyers straight into new construction. And over at Macy's, the company's prime, deep-value real estate portfolio provides a massive safety net. Now let's look at the other side of the ledger. Where is Berkshire pulling money out? The most ruthless exit was Constellation Brands. Their entire $95 million stake was dumped to the very last share, but the real warning siren came straight out of the financial sector. Berkshire dumped 58% of its stake in credit card powerhouse Capital One, right as the company is navigating its Discover mega-merger. Why? Because Buffett has long warned about the systemic vulnerabilities in banking and credit.
But I do think banking could get in a lot of trouble just because of the kind of things that they did, and that I didn't like the banking business as well as I did before.
Smart money reads the room. Everyday consumers are financially stretched, credit card delinquencies are rising, and holding heavy risk in unsecured consumer debt is no longer an attractive bet. The portfolio trim continued. They cut their stake in steel titan Nucor in half and shaved 22% off supermarket giant Kroger. What about big oil? They didn't sell a single share of Chevron or Occidental Petroleum. However, falling global crude prices erased nearly $8 billion from their combined market value. They are standing their ground, but broad commodity corrections took a serious bite out of their portfolio. What is the big takeaway for everyday investors? First, institutional money no longer fears big tech as long as it generates reliable free cash flow with an impenetrable moat. Second, serious storm clouds are gathering over retail consumers and credit cards. Be careful where you allocate capital. If you liked this video and want to stay ahead of what smart money is doing before the market reacts, hit that subscribe button and drop a like.